Be Wealthy and Smart, episode 1165.
I'm gonna live the rich life, full and best life. So if y'all know what I mean, put your hands up and declare with me. Yeah, I'm full of it. I'm gonna live the good life, beautiful and glorious life.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the 1-year anniversary of interest rates rising. Not because it's such a great anniversary, it was March 17th of 2022 when Chairman Powell first raised interest rates by 0.25%. At that time, it's hard to believe that the Fed funds rate was 0.25% to 0.5%, and that as recently as the first quarter of 2022, the Fed funds rate was at around 0. 1 year later, the Fed has raised interest rates 8 different times, and at times making very large jumps of 0.75%. So in May, we had a 0.5% increase. In June of 2022, a 0.75% increase. In July, a 0.75% increase. In September, another 0.75%. In November, 0.75%. So 4 in a row of 0.75%. Then December 14th, 0.5%. And then in January, 0.25%. Now we're back to talking about 0.5% hikes again, maybe going farther and faster. It's hard to believe, but rates have gone up 4.75% in just a year. And today we're talking about approaching a 6% interest rate. But the economy has held up well, and although last year all the harping was on recession, what's really happened is the economy has been so strong that Chairman Powell is now talking about raising rates more. But there is one problem. While he would like to see the labor market come down and not be so strong, the problem is raising interest rates has a lag time before we see the effect. So raising them fast and raising them 0.75% at a time, it takes time for that to filter through the economy and to slow things down. And what the Fed typically does is they raise interest rates so fast and so sharply that eventually the data comes in weaker. And they have to do an about face and go in the other direction. I don't think we're quite there yet, but I think we could get there a little bit later this year, where the Fed has just overdone it and has to do an about face. But here's what happened today. Today, we had a bit of a run on the banks. We had Silvergate basically close their doors because they had some losses due to FTX, but they also got caught with a bond portfolio that was underwater, that was highly leveraged. So in the end, it was just not having enough deposits and having a run on the bank that made them close their doors. Although the talking heads are blaming it all on crypto. Then we had Silicon Valley Bank say they were essentially having problems. Now this is a tech bank that typically has venture capital clients, and a year ago they had lots of deposits coming in with venture capital, and they had to do something with that money, and they put the money into bonds, and the bonds went upside down when interest rates went up. So today they sold some stock, and they'll be able to shore up the company probably pretty well, I would imagine, by being able to sell the stock. It allowed them to get immediate liquidity, and it will be accretive to their earnings. So that's a positive for them. But there is this liquidity crunch from interest rates going up, and it is drying up liquidity. It is causing some issue. There probably will be other banks that have some troubles like this, other financial institutions, other holders of bond portfolios, etc. It seems like these aren't isolated events, and that this is going to appear with other financial institutions. Now, the other thing that can happen is we can get a spike in interest rates. That would be the thing I'm really looking for, is what happens if interest rates spike. If interest rates spike, it not only would cause harm with a bond portfolio, but it would also cause harm with a derivatives portfolio, which is where the big banks have a lot of money invested. Warren Buffett called derivatives weapons of mass destruction. And truly, if interest rates spiked, that could cause the value of the derivatives to drop and could cause banks to become insolvent. This is the real worry that we have to watch for. So we'll have to see how this plays out. But should there be any contagion in the banking system? So after Chairman Powell talked about interest rates maybe going higher than expected and maybe moving up 0.5% at a time instead of 0.25% at a time, the Fed funds futures repriced that in. And the next Fed meeting is March 21 and 22, so we'll hear what their decision is at that time. The February non-farm payroll report and the unemployment figures expected today will probably move the interest rates in the futures market and tell us which direction they think Chairman Powell will go. If the numbers come in stronger than expected, interest rates will rise, and the chances that Chairman Powell will increase rates 0.5% will increase. If, however, the reports come in weaker than expected, interest rates will fall, which will cause the stock market to rally and interest rate futures to reprice and readjust to lower rates. This was all basically caused from the January inflation data, plus signs that the labor market remains remarkably strong despite the Fed's efforts to slow it down. Only weeks ago, Chairman Powell was talking about disinflationary forces at work, but now he's talking tough again on monetary policy. Goldman Sachs said if the Fed should have to tilt in the more aggressive direction, it could have market impacts, with stocks selling off more sharply and downward pressure on commodities, plus upward pressure on the dollar. Joseph Brusuelas, chief economist at advisory firm RSM, said the economy is just too resilient at this point. They need to generate sufficient labor slack to cool off the economy. Well, we'll see how the numbers come in and which way the market goes. If the numbers come in hotter than expected and interest rates jump, this could cause more problems for more financial institutions and their bond portfolios being underwater. We'll keep an eye out and report to you about it as we see it. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.